Portfolio management. What is the difference between systematic risk and unsystematic risk? Systematic risk, a risk inherent to the entire market or entire market segment. It is the systematic risk. Unsystematic risk, a risk inherent to the specific company or industry. It is unsystematic risk. Systematic risk is also called as uncontrollable risk. Unsystematic risk is also called as controllable risk. Systematic risk is macro in nature, whereas unsystematic risk is micro in nature. Types of systematic risk: interest rate risk, market risk, purchasing power or inflationary risk. Types of unsystematic risk: business risk, liquidity risk, business or liquidity risk, financial or credit risk. Systematic risk is also called as market risk, non-diversifiable risk. Unsystematic risk is also called as diversifiable risk. Systematic risk example is recession, wars. Unsystematic risk example is strike by employees of a company. Unsystematic risk. Next, what are the objectives of portfolio management? First one, security of the principal investment. Second, consistency of the returns, that is stability of income. Next, risk reduction, that is diversification. Fourth, capital growth. Fifth, liquidity. Sixth, marketability. Seventh, favorable tax treatment. First one, security of the principal investment. Portfolio management not only involves keeping the investment intact but also contributes towards the growth of its purchasing power over the period. The motive of a financial portfolio management is to ensure that the investment is absolutely safe. Second objective of portfolio management is consistency of returns, that is stability of income. Portfolio management also ensures to provide the stability of the returns by reinvesting the earned returns in profitable and good portfolios. Next, risk reduction, that is diversification. Portfolio management is purposely designed to reduce the risk of loss of capital and our income by investing in different types of securities available in a wide range of industries. The investors shall be aware of the fact that there is no such thing as zero risk investment. Next, capital growth. Portfolio management guarantees the growth of capital by reinvesting in growth securities or by the purchase of growth securities. Next, liquidity. Portfolio management is planned in such a way that it facilitates to take maximum advantage of various good opportunities upcoming in the market. The portfolio should always ensure that there are enough funds available at short notice to take care of the investors' liquidity requirements. Next, marketability. Portfolio management ensures that flexibility to the investment portfolio. A portfolio consists of such investment which can be marketed and traded. Next, favorable tax treatment. Portfolio management is planned in such a way to increase the effective yield an investor gets from his surplus invested funds. By minimizing the tax burden, yield can be effectively improved. Write a short notes on modern portfolio theory or write a short notes on Markovitch model of risk return optimization. Harry M. Markovitch is credited for the introduction of a new concepts of risk measurement and their application to the selection of portfolios. He started with the idea of risk aversion of average investors and their desire to maximize the expected return with the least risk. This theory is for the analysis of risk and return and their interrelationships. Harry Markovitch is regarded as father of modern portfolio theory. Markovitch explains an effective portfolio as expected to yield the highest return for a given level of risk or lowest risk for a given level of return. Markovitch emphasized the quality of portfolio will be different from the quality of individual assets within it. Thus, the combined risk of the two assets taken separately is not the same risk of the two assets together. Investors take into account two major aspects of the investment, risk and return. The modern portfolio theory emphasizes the trade-off between risk and return. If the investor wants a higher return, he has to take the higher risk. But he prefers the higher return for low risk, and hence the need for a trade-off arises. Need for the trade-off arises. The modern portfolio theory explains the risk of each security is different from that of the others, and by a proper combination of securities called diversification risk of one is set off partly or fully by that of the other. Next, state the assumptions of Markovitch model or modern portfolio theory. First one, investors are rational and desire to maximize their return with the money available for investment. Second, the investors have free access to fair information of returns and risk. Third, the markets are efficient and absorb the information quickly and perfectly. Fourth, investors are risk averse and are in search of maximizing returns and minimizing risk. Standard deviation or variance and expected returns are the basis for investors to take the decision. Investors prefer higher returns for a given level of risk. What is efficient frontier? Markovitch has formalized the risk-return relationship and developed the concept of efficient frontier. For selection of a portfolio, comparison between combination of portfolios is essential. In case of efficient frontier, in x-axis standard deviation will be quoted, in y-axis return will be shown, and in the graph various types of investments will be considered. They will be selected based on risk and return. Risk means standard deviation. As a rule, a portfolio is not efficient if there is another portfolio with a higher expected value of return and a lower standard deviation, that is a risk. A higher expected value of return and the same standard deviation, that is risk. The same expected value but a lower standard deviation, that is risk. Markovitch has defined the diversification as the process of combining assets that are less than perfectly positively correlated in order to reduce the portfolio risk without sacrificing any portfolio returns. If an investor's portfolio is not efficient, he may increase the expected value of return without increasing the risk, decrease the risk without decreasing the expected value of return, or obtain some combination of increase of expected return and decrease risk. Next, what are the assumptions of CAPM, capital asset pricing model? All investors are rational and risk averse. All investors are broadly diversified across a range of investments. All investors are price takers, that is, they cannot influence price. All investors can lend and borrow unlimited amount at a risk-free rate of interest, that is RF. Next, trade without any transaction or taxation cost. Assumes all information is available at the same time to all the investors. Assumes that all assets are divisible and are liquid. Assumes that securities or capital assets does not face any bankruptcy or insolvency. These are the assumptions of CAPM, capital asset pricing model. What are the advantages and limitations of CAPM? Advantages of CAPM. There are 3 advantages of CAPM. First one, only systematic risk. It considers only systematic risk, reflecting a reality in which most investors have diversified portfolios from which unsystematic risk has been essentially eliminated. Second, better method to calculate cost of equity. Better method to calculate cost of equity, KE. It is generally seen as much better method of calculating the cost of equity than the dividend growth model, in that it explicitly takes into account a company's level of significant risk related to the stock market as a whole. It is useful in computing cost of equity of a company which does not declare dividend. Third benefit is it can be used as risk adjusted discounting rate, RADR. It provides reasonable basis for estimating the required return on an investment which has risk inbuilt into it and hence can be used as risk adjusted discounting rate, RADR, in capital budgeting. What are the limitations of CAPM? 3 limitations. First one, unreliable beta. Shares of many companies may not have reliable beta. Next, hard to get the market information. Information on a risk-free rate of return on market portfolio may not be possible to obtain as there exist multiple rates in the market. Third, no transaction cost. Next, write a short notes on active and passive portfolio strategy. Active and passive portfolio strategy. Portfolio management strategies refers to the approaches that are applied for the efficient portfolio management in order to generate the highest possible returns at lowest possible risks. There are 2 basic approaches for the portfolio management, including active portfolio management strategy and passive portfolio management strategy. First one, active portfolio management strategy. The active portfolio management strategy relies on the fact that particular style of analysis or management can generate returns that can beat the market. It involves higher than average cost, and it stresses on taking advantage of market inefficiencies. It is implemented by the advice of the analysts and managers who analyze and evaluate market for the presence of inefficiencies. The active management approach of the portfolio management involves the following styles of stock selection. First one, top-down approach. Second, bottom-up approach. First one, top-down approach. In this approach, managers observe the market as a whole and decide about the industries and sectors that are expected to perform well in the ongoing economic cycle. After the decision is made on the sectors, the specific stocks are selected on the basis of companies that are expected to perform well in that particular sector. Next, bottom-up approach. In this approach, the market conditions and expected trends are ignored, and the evaluations of the companies are based on the strength of their product pipeline, financial statements, or any other criteria. It stresses the fact that strong companies perform well irrespective of the prevailing market or economic conditions. Second strategy is passive portfolio management strategy. Passive asset management relies on the fact that markets are efficient, and it is not possible to beat the market returns regularly over time, and best returns are obtained from the low cost investments kept for long term. Next, the passive management approach of the portfolio management involves the following styles of stock selection. First one, there are 5 styles. First one is efficient market theory. This theory relies on the fact that the information that affects the market is immediately available and processed by all investors. Thus, such information is always considered in evaluation of the market prices. The portfolio managers who follows this theory firmly believes that market averages cannot be beaten consistently. Second style is indexing. According to this theory, the index funds are used for taking the advantages of efficient market theory and for creating a portfolio that impersonate a specific index. The index funds can offer better benefits over the actively managed funds because they have lower than average expense ratios and transaction cost. Apart from the active and passive portfolio management strategies, there are 3 more kinds of portfolios, including patient portfolio, aggressive portfolio, and conservative portfolio. First one, patient portfolio. This type of portfolio involves making investments in well-known stocks. The investors buy and hold stocks for longer periods. In this portfolio, the majority of the stocks represents companies that have classic growth and those expected to generate higher earnings on a regular basis, irrespective of financial conditions. Second one, aggressive portfolio. This type of portfolio involves making investments in expensive stocks that provide good returns and big rewards, along with carrying big risks. This portfolio is a collection of stocks of the companies of different sizes that are rapidly growing and expected to generate rapid annual earnings growth over the next few years. Next one, conservative portfolio. This type of portfolio involves the collection of stocks after carefully observing the market returns, earnings growth, and consistent dividend history. What are the features of hedge funds? Hedge funds utilize a variety of financial instruments to reduce risks, enhance returns, and minimize the correlation with the equity and bond markets. Many hedge funds are flexible in their investment options, can use short selling, leverage, derivatives such as puts, calls, options, futures, etc. Next, hedge funds vary enormously in terms of investment returns, volatility, and risk. Many but not all hedge fund strategies tend to hedge towards downturns in the markets being traded. Many hedge funds have the ability to deliver non-market correlated returns. Many hedge funds have as an objective consistency of returns and capital preservation rather than magnitude of returns. Many hedge funds are managed by experienced investment professionals who are generally disciplined and diligent. Next, explain hedging strategies. First one, selling short. Selling shares without owning them, hoping to buy them back at a future date at lower price in the expectation that their price will drop. It's called as selling short strategy. Next, using arbitrage. Seeking to exploit price inefficiencies between related securities. For example, can be long convertible bonds and short the underlying issuer's equity. Long means buy, short means sell. Next, trading options and derivatives. Contracts whose values are based on the performance of any underlying financial asset, index, or other investments is called as trading options and derivatives. Next, investing in anticipation of a specific event, merger transaction, hostile takeover, spin-off, exiting of bankruptcy proceedings, etc. comes under investment in anticipation of a specific event. Next, investing in deeply discounted securities of a company about to enter or exit financial distress or bankruptcy, often below liquidation value, we can buy the securities. Explain the benefits of hedge funds. Many hedge fund strategies have the ability to generate positive returns in both rising and falling equity and bond markets. Inclusion of hedge funds in a balanced portfolio reduces overall portfolio risk and volatility and increases returns. Huge variety of hedge fund investment styles, many uncorrelated with each other, provides investors with a wide choice of hedge fund strategies to meet their investment objectives. Academic research proves hedge funds have higher returns and lower overall risk than traditional investment funds. Hedge funds provide an ideal long-term investment solution, eliminating the need to correctly time entry and exit from the market. Adding hedge funds to an investment portfolio provides diversification not otherwise available in traditional investing. Explain different types of asset allocation strategies. Many portfolios containing equities also contain other asset categories, so the management factors are not limited to equities. There are four asset allocation strategies. First one, strategic asset allocation. Strategic asset allocation is an investment strategy focused on the needs of the investors rather than the constant tracking of the markets, and is thought to remove the influence of emotion from investment strategies. Under, the, under this asset allocation strategy, optimum optimum portfolio mixes based on returns, risk, and covariances is generated using historical information and adjusted periodically to restore target allocation within the context of the constraints. Next, tactical asset allocation. Tactical asset allocation. Tactical asset allocation is an active management portfolio strategy that shifts the percentage of assets held in various categories to take advantage of the market pricing anomalies, or strong market sectors. This strategy allows portfolio managers to create extra value by taking advantage of certain situations in the marketplace. It is as a moderately active strategy since managers return to the portfolio's original strategic asset mix when desired short-term profits are achieved. Next, ensued asset allocation. With an ensued asset allocation strategy, you establish a base portfolio value under which the portfolio should not be allowed to drop. As long as the portfolio achieves a return above its base, you exercise active management to try to increase the portfolio value as much as possible. If, however, the portfolio should ever drop to the base value, you invest in the risk-free assets so that the base value becomes fixed. At such time, you would consult with your advisor on reallocating assets, perhaps even changing your investment strategy entirely. Ensued asset allocation may be suitable for risk-averse investors who desire a certain level of active portfolio management but appreciate the security of establishing a guaranteed floor below which the portfolio is not allowed to decline. For example, an investor who wishes to establish a minimum standard of living during retirement might find an ensured asset allocation strategy ideally suited to his or her management goals. Next, integrated asset allocation. With integrated asset allocation, you consider both your economic expectations and your risk in establishing an asset mix. While all of the above mentioned strategies take into account expectations for future market returns, not all of the strategies account for investment risk tolerance. Integrated asset allocation, on the other hand, includes all aspects of the includes aspects of all strategies, accounting not only for expectations but also actual changes in the capital markets, and your risk tolerance. Integrated asset allocation is a broader asset allocation strategy, albeit allowing all only either dynamic or constantly weighing allocation. Obviously, an investor would not wish to implement two strategies that compete with one another. What is alternative investment? An alternative investment is an asset that is not one of the conventional investment types such as stocks, bonds, and cash. Most alternative investment assets are held by institutional investors or accredited high net worth individuals because of the complex natures and limited regulations of the investments. Alternative investments includes private equity, hedge funds, managed futures, real estate, commodities, and derivative contracts. What are the features or characteristics of alternative investment? Though here may be many features of alternative investment, but following are some common features. First one, there are 6 features. First one, high fees. Being a specific nature product, the transaction fees are quite on higher side. Second, limited historical cost rate. Limited historical rate. The data for historic return and risk is very limited, where data for equity market for more than 100 years is available. Next, illiquidity. The liquidity of alternative investment is not good as next buyer not be easily available due to limited market. Buyer is not available easily. Next, less transparency. The level of transparency is not adequate due to limited public information available. Next, extensive research required. Due to limited availability of market information, the extensive analysis is required by portfolio managers. Next, leveraged buying. Generally, investment in alternate investments is highly leveraged. What are the different types of alternative investments? Over the time, various types of alternative investments have been evolved, but some of the important alternative investments are mutual funds, real estates, exchange traded funds, private equity, hedge funds. Next, closely held companies, distressed securities, commodities, managed futures, mezzanine finance. Next, what is mezzanine finance? Mezzanine finance is a blend or hybrid of long-term debt and equity share. It is a kind of equity funding combined with the characteristics of conventional lending as well as equity. This is a highly risky investment and hence mezzanine financer receives higher return. This type of financing enhances the base of equity as in case of default, the debt is converted into equity. Mezzanine financing can be used for financing heavy investments, buyouts, temporary arrangement between sanction of a heavy loan and its disbursement. However, compared to Western world, this type of financing is not so popular in India. Next, what is distressed securities? It is a kind of purchasing the securities of a company that are in near bankruptcy. Since these securities are available at very low price, the main purpose of buying such securities is to make efforts to revive the sick company. Further, these securities are suitable for those investors who cannot participate in the market and those who wants avoid due diligence. Now question arises, how profit can be earned from distressed securities? We can see by taking long position in debt and short position in equity how investors can earn arbitrage profit. In case company's condition improves because of priority, the investors will get his interest payment, which shall be more than the dividend on his short position in equity shares. If company's condition further deteriorates, the value of both shares and the debenture goes down. He will make good profit from his short position. Next, what are the types of risks has to be analyzed before investing in distressed securities? On the face, investment in distressed securities appears to be a good proposition, but following types of risks are to be analyzed. First one, liquidity risk. Second, event risk. Third, market risk. Fourth, human risk. Liquidity risk, event risk, market risk, human risk. Liquidity risk. These securities may be saleable in the market or may not be saleable in the market. So there is no liquidity position. Second, event risk. Any event that particularly affects the company, not economy as a whole, should be considered. Next, market risk. This is another type of risk though it is not important. Next, human risk. The judge's decision on the company in distress also plays a big role.